Breakthrough Real Estate Investing Podcast, episode 101.
Welcome, everyone. Thanks for joining us again today. Hey, Sandy, how are you?
Hey, Rob. Fantastic. Yourself?
Very, very good. Just still sort of in the first phase of my first multifamily deal. And Dalia knows about that, our guest. So we'll maybe touch on that a little bit, although I don't want to get into anything too personal on this. But yeah, it's pretty exciting. And, a couple other things going on. How about you?
Nice. Yeah, lots of stuff. I guess we're fresh off our 100th episode, so that was cool to do all that at the event. And then I was just looking forward to making that event exciting, and that's been a lot of my focus for the last while. So back to kind of normal business and buying some properties and doing all that fun stuff.
Right on, right on. Everyone should go over to our website, breakthroughreipodcast.ca. There you can listen to every single episode that we've done. And you can also get in contact with the guests because all of their contact info that they've shared will be there and available for anyone who would like to get in touch. So please go over and do that. breakthroughreipodcast.ca. What else can they do over there, Sandy?
Grab our free report, the ultimate strategy for building wealth in real estate. And that'll come with it as you jump on our email list and get access to all that stuff that Rob mentioned there. Get access to our property tours, our events that are coming up, get notified of every episode that we release, and just hopefully our goal there is just to deliver more value to you. So jump on that list and get access to everything there.
Great. As well, jump over onto iTunes and subscribe to the podcast there. You can leave a rating and review, which would be greatly appreciated. For anyone who just has a couple of minutes, can go over and tell us what they think about the episodes that they've heard so far and the guests, and maybe even what they'd like to hear more of on the show. So if anyone would care to leave us a review, it'd be greatly appreciated.
We've got some great recommendations. I've seen some come through the last couple of weeks that have been interesting. So we're going to have a few new topics, I think, if we can track down some good guests. There are some good ones there, Rob, that have come through.
Well, you know what? I'll shout it out right now. Somebody asked us to do a podcast about agricultural land and renting it to farmers and that kind of thing. So if we have any experts in that kind of area listening to this, then please get in touch with us at info@breakthroughreipodcast.ca. We'd love to hear what you have to say and possibly have you as a guest on the show. Talk about it.
Yeah.
Well, I guess we've gotten through all the housekeeping, Sandy, so we should probably talk to our guest.
Sounds good. Yeah, we've got Dalia standing by. So welcome to the show, Dalia.
Thank you, folks. Thank you for the opportunity.
Oh my gosh, this has been such a long time coming here. We've had so many mishaps, and we almost did this interview one time before, and then we had a bunch of technical difficulties, I think, and then you were sick, and then I was sick, and Sandy was probably sick in there too somewhere, but we're finally doing it today. So thanks for being here. Appreciate it.
We're here. All good.
I'm pretty excited, and we are doing something a little bit differently today. We're going to get to, I put it out on Facebook and Instagram that you were going to come on the show and talk to us today. And I have a bunch of listener questions here to ask too. So that'll be interesting to get into that.
Excellent.
Perfect. And for those of you who don't know Dalia Barsoum, she's an award-winning mortgage broker, a financial advisor. She's got over 20 years experience in the banking sector, wealth management, lending, and real estate. She's the author of Canada's best-selling real estate financing book, and it's an Amazon bestseller as well, Canadian Real Estate Investor Financing, 7 Secrets to Getting All the Money You Want. And she's been nominated for a whole bunch of awards here. I'm not going to get through all of them. Top 75 brokers 2017, 18, 19 in the Canadian Mortgage Professionals. What else here? Top mortgage broker 2017, 2015, Canadian Real Estate Wealth Magazine, a Woman of Influence 2017. Top 100 women driving and reshaping the Canadian real estate industry, and a whole bunch of others. And she's a public speaker. She's a regular columnist in the Canadian Real Estate Wealth Magazine and various other media outlets throughout the real estate and financing world. And she's the president and principal broker of Streetwise Mortgages, which is one of Canada's top 75 brokerages as ranked by Canadian mortgage professionals. And Dalia helps many real estate investors kickstart their investment plans, as well as take their portfolio to the next level. And her clients range from rookie investors to more sophisticated investors with multi-million dollar portfolios, and a whole bunch of more things, but we'll probably get into all that sort of stuff as we get through the interview. So again, welcome to the show, Dalia. Happy to have you here.
Thank you very much, Sandy.
Yeah, thanks, Dalia. Thanks for being here. Sandy, you must be exhausted after going through those accolades.
I was trying to take some breaths there, but that was a long one. Yeah.
Thank you, Sandy, for the comprehensive intro.
What else do you want to add to that? What about family, stuff you do for fun, that kind of thing?
Yes, well, I have two beautiful sons, Alexander and Vincent, 12 and 8. And I have a Labradoodle. His name is Yogi. That's my little family. And what I like to do for fun is I do a lot of things, but mainly I like to take long walks with my dog. I like to travel with the kids and my husband. And I actually enjoy and love and addicted to Latin music. So I listen to a lot of Latin music. I do a lot of salsa dancing and Latin dancing. And on the sports side, I play also soccer.
Very, very good. That sounds like fun.
Yeah.
Okay. Now, I'm sure what most people who are listening to this real estate investing podcast are interested in, though, is the real estate side of it. So let's get into that. So not only are you an investor-focused broker, but you're also an investor yourself. So do you want to tell us a little bit about your investing journey so far?
Sure. I started investing at about 2008 when the markets took a hit. And at that time, I was actually working for one of Canada's largest big banks. And I saw my stock portfolio sink. And my husband and I felt that we had no control at the time. And this is where we started shifting gears to real estate. So I started with a small property in Southwest Barrie. At the time, I purchased a townhouse. And from there, I grew my portfolio in Barrie. So I am primarily invested in Southwest Barrie and in Northwest Barrie. And I also got into Vaughan many years ago before Vaughan Mills and the subway station came to life. So my primary portfolio is all buy and holds. I haven't done any fancy footwork when it comes to flipping or renovations, but recently in Barrie, I started acquiring properties that allow for the legalization of secondary suites. And as we speak right now, I am putting offers on Toronto properties to do a buy, renovate, refinance in Toronto. It's more massive, type of renovation, but the numbers make sense for us. So that's where I am right now. And then the rest of my portfolio, I supplement with private mortgages.
So when you say Toronto, do you mean Toronto proper or like
Toronto?
Right
so basically, yeah. So Rob, basically buying a property that is run down in a prime location in Toronto within minutes to the subway station. You're looking at a million or 1.2, that's the range. Mm-hmm. And what we would do is we would literally gut the property. It costs about $200,000 to $300,000 in renovations. It's, like I said, it's a massive investment, but at the end of the day, the push in value is significant in a market like Toronto. And what we do is we create 3 or 4 units inside the property so that our gross rental income jumps to about $6,000 or $6,500 renting to professionals.
Very, very
so
good.
It's the BRRRR strategy, but in Toronto. So that's what I'm doing right now.
Very cool. That's awesome. And then you started out with buy and holds, you said, and just sort of, that worked for you for the first little while. But as I would imagine everybody gets sort of the itch to recycle their money a little bit and be a little bit more adventurous and try some new things. So that's very cool.
Yeah, I mean, it's all been buy and hold. I haven't flipped property, like I said. Recently, I started buying things to legalize a secondary suite, but my most massive, I guess, strategy is the one that I'm deploying in Toronto right now.
So, I mean, as far as the people that we generally talk to in this podcast, most of them are new investors. they're building their portfolio still. They're using different strategies, but typically they're doing buy and holds, either that or rent to owns, student rentals, some flipping, and
Yep.
then what you just talked about with the buy, refi, buy, renovate, refinance, and rent strategy. How do you suggest that investors set themselves up for success using each of these strategies? So let's just start with a straight up buy and hold.
So so at the end of the day, when an investor wants to pick a strategy, what's important is to understand why they are deploying that strategy. What are they after at the end of the day? Are they after capital growth so that they can grow maybe their down payment money through a flip or a rent to own that matures in 3 years, so we can take that and put it into long-term buy and holds? Or are they primarily after cash flow, and therefore they're looking at maybe student rentals or rent to own or legalization of secondary suites? So it starts with understanding why they're actually tackling that strategy. From a financing standpoint, what you should consider is not just the mortgage and the rate. As an investor, you need to understand what your plan is for the property. So if you're getting into a buy and hold, okay, and you know that this property is something you're going to keep for the long run, you really want to make sure that you have a couple of features. One, I'm a big believer of what's called an advanceable mortgage on a long-term buy and hold. As an investor, you're going to run into issues sometimes with tenants. You're going to run into repairs sometimes with tenants. You need some reserves to carry your properties. So an advanceable mortgage on a long-term buy and hold allows you to accumulate capital over time on a line of credit as you pay down the mortgage. So it gives you access to that reserve. So I would highly suggest, an advanceable mortgage on a long-term buy and hold. On a rent to own, you want to make sure that you have flexibility primarily. Because you got a tenant buyer who's going to buy the property from you, let's say in 3 years, and you need to think about two things. What if that tenant buyer does not buy the property from you and needs an extension? And what if they buy it from you before the end of the term because they've done great and they can actually buy it sooner? So what I typically suggest on a rent to own is a variable rate mortgage, because a variable rate mortgage gives you that type of flexibility. If they extend, you don't have to renew your term. And if they buy early from you, you can break that mortgage with the least penalty, okay? On a student rental, student rentals are trickier. If you're buying a student rental, if you're buying a property that looks and smells like a student rental from the get-go, there are very few lenders that will do that type of deal. They are financeable, but what you need to think about is, what if later you want to take money out of that property, which we all do as investors? We want to recycle our capital. So again, on a student rental, because your universe of lenders going in is a little bit limited, you want to think ahead of time. And I would recommend also an advanceable mortgage on a student rental, because on a refinance, it's a little bit more challenging. So if you have an advanceable mortgage, that would allow you to get access to capital in an easier format. And then finally, on a buy, renovate, refinance, what we recommend to investors is to consider a mortgage with two key things. One, going into the deal, go variable. Don't go fixed, because once you're done that renovation, as an investor, you want to be able to go back, refinance it, pull your money out, pay your reno capital, and if you've done it really, really well, you'll get some extra funds to take it to your next deal. So do it variable, so you give yourself the flexibility to pull the money out once you're done, but also go to a lender or talk to your broker to work with a lender that will allow you to revisit the value once the work is done. Not a lot of lenders will let you refinance at the appraised value once you're done. Some lenders will say, sorry, you know what, guys, you've owned this property only for 3 months, and all of a sudden you're telling us that the value has jumped by $100,000. We're not going to touch it. So for an investor who's doing a burst strategy, you got to make sure your exit strategy is open, not like go with a variable rate, and you're working with a lender that allows you to refinance at appraised value in a short time period. So that's what I would recommend on the different strategies.
So that was interesting what you said on the student rental thing, just having a re-advanceable mortgage. So that means that that you wouldn't necessarily have to have it appraised in order to pull the value, well, you would. So let's walk through that really slowly, because I know that a lot of my clients and a lot of people that I'm working with right now are doing student rentals as an initial strategy, but the properties that we're into are also able to be used for second suites down the road if they want to do that kind of thing. But let's just assume that they're going to stay as a student rental. The term is up. They've held the mortgage for 5 years. Now they think that the property has appreciated. They haven't really made any changes by renovating or anything like that. It's just over time they feel that the property is appreciated. Now they want to access that additional income. So that's not what you were talking about there. You were more talking about if you pay the mortgage down, you can then have access to those funds again.
Yes.
Up to whatever the initial amount of the appraisal was.
Yes.
What if we want to get access to the new appraised value?
Okay, so so knowing if you're going to invest in a student rental, we want to make sure that upfront we plan the portfolio so that when the time comes, we're able to refinance that deal back with the lender who initially approved it for you. Because what typically happens is, as you grow your portfolio, you outgrow the guidelines of the lenders that you have worked with initially. So you go to property number 6 or number 7, but you have, let's say, 5 student rental properties that we financed with a bank early on, and you come and say, Dalia, I want to pull equity. These properties have a lot of money in them. If you have outgrown the guidelines of the lender we initially worked with, then you would have less options to work with. But if we upfront say, you know what, let's make sure that when we allocate your deals, we're structure your portfolio in a way so that we preserve your borrowing power with that lender that has lent you on your student rentals, then that would leave your options open with these lenders later down the road to go back and do a full refinance. Okay, that's one way. The other way is there are lenders that will consider student rentals if everybody is on a master lease agreement versus, you know, sub leases. Okay, so it works better for financing if you have a master agreement with names versus, you know, room rentals as well. It gives you more options to do a full refinance.
So really what you're saying is when people want to get into real estate investing, they should have a good idea of what they want to do down the road and talk to somebody like yourself in order to set things up like this. Because really mortgage, like the rate, you know, the interest rate is not necessarily the most important thing, which a lot of people, that's what they drill down on. What interest rate can I get?
Yes, the interest rate is important to all of us, and we definitely want to make sure that your cost of borrowing stays reasonable given your strategy. But what's most important for real estate investors, I find, is how they want to grow. We all want to recycle equity to grow. A lot of us recycle equity to grow. So it's important to think ahead of time of how you're going to grow. If you take a 5 years fixed rate, I just came across an investor that I met yesterday came to us and said, Dalia, I want to grow my real estate portfolio, but I just locked with my bank on my 4 properties on a 5 years fixed rate at 2.79. And unfortunately, they locked with a bank. When I ran the numbers, they locked with a bank that they cannot qualify further with to extract any money out of their properties, whether it's a line of credit or a mortgage. So unless they break this big loan and go somewhere else, they can't move forward. But that's the rate mentality. They locked in because the bank sold them on a rate. And yes, the rate was great, but what's your strategy as an investor? What do you want to do? And how can we make sure that we structure things to, you know, allow you to do what you want to do? It's really beyond just the rate.
Yeah, those are great points. Those are actually really, really important points, because the amount of people I'm sure you come across a lot, Dalia, Rob, both of you, that have locked into those types of scenarios and they're stuck, right? They can't move ahead. All it takes is a little upfront work, getting connected with some of the right people, and that all can be solved up front, right? What are some other, so that's one, obviously a mistake there. What are some other common mistakes that you see with people in the lending world?
So what I see, one common mistake is assumptions. Okay, assumptions clients sometimes make the wrong assumptions around what they qualify for from a financing standpoint. Okay, they know they make good income, they have great credit, and they say, okay, I'm getting a deal from my realtor. I'm gonna crunch my numbers based on this amortization, based on this down payment, based on this rate. And then once the time comes for financing, if they haven't planned it ahead of time, they may end up with different financing numbers and get surprised. So it's a very common mistake. Do not assume financing. Plan financing. When you plan financing, you will know not just what you qualify for on your next deal, but if you talk to an investor-friendly broker, you'll be able to map out what your financing game plan looks like for at least your next 3 to 4 deals. And you would know where your money's coming from, what your rates are going to be, what your amortization is, what your exit strategy looks like. All of these things have to be covered before you actually go into a deal. And then it's like, then you're running, you're really executing. It's like a cookie cutter. So assumptions is a big mistake. The other one is getting fixated on the rate, which is the second biggest mistake.
Rob, any other mistakes you see from people commonly in that world, or no? The big ones for me is the getting in that fix. I come across a lot of people that haven't, they have a few properties and they're in on, like you mentioned, have that fixed rate, and they're people always ask what's better, fixed or variable. I mean, I'm pretty much every time on the variable side just because of flexibility.
I know everybody's going to hate this answer. It depends.
Yeah.
Everybody hates the answer. Hates the it depends answer, but it truly depends. It depends on what your plan is as an investor. What's your plan for the property? What's your long-term plan? Are you going to rely on equity to grow? Are you going to flip this property? Are you going to sell this property? Are you going to renovate it and refinance it? That drives the type of rates, we go into. The black or white answer is right now, as it currently stands, fixed rate is fantastic. It's at its lowest point. You're going to get a great fixed rate compared to going variable. But then you marry that with everything else and you put context around it, and it may not make sense for an investor depending on what they're doing. Mm-hmm. So it really depends.
Mm-hmm.
And maybe not a mistake, Sandy, but one of the things that I definitely see sometimes happen is, you'll get an unfavorable appraisal once you've done the renovations and you want to have access to that new value, the money from the new value. The appraisal comes in and it's completely unfavorable. What do you suggest people do when that happens?
Okay, so for investors who are renovating a property, I always suggest that they put together a binder, okay, outlining what they've done to the property, how much they spent, and get comparables, true comparables from their realtor. Then we take that, pass it on to the appraiser and say, hey, here's everything you need to help you with your homework, to help you with your valuation. That's one key thing we do on renovated properties. The other thing is knowing who's gonna go appraise your property, okay? There are appraisers who know the local market really well. And there are appraisers, as much as they're putting in their best effort, they don't know the local market as well. So real estate is a local market. Your realtor knows the local market. Your appraiser knows the local market. Your broker should know the local market. And knowing the local market is key in determining what value is. So this is where, we work with appraisers who know the local market really well, but also do our homework up front by sending them this package that will help them, support the best value.
Mm-hmm. And you'll tell them what you're looking for, what the investor's looking for. Does that help?
Of course, yes. Of course, we on every deal we would convey to the appraiser what we're looking for.
Mm-hmm.
So we do have some questions, I guess, Rob, from some of our listeners that have reached out and wanted to know some things here. So Godfrey wanted to know, what is the difference between A, B, and C lenders? How do we determine the difference there? People toss those terms around a lot, and a lot of people may not know what that is. So what does that mean?
Okay, I can write a book on A, B, and C lenders, but I'll give you the summary on these 3 categories. So what's categorized as an A lender is a lender that will give you the best financing terms generally on a property. Okay, so that's 20, if you're buying rentals, 20% down, 30-year amortization, and a reasonable rate. Okay, there are some A lenders that will also do 25 down, 30-year am, also great rate. So it's really, A lenders are all around the rates. Okay, and then there are variations when it comes to down payment from 20 to 25 down. B lenders, before I get into B lenders, actually, the A lenders are also the lenders that work with good credit, so 650 and above. Now, the B lenders are the lenders who will work with clients who have more creative, okay, types of scenarios. So self-employed clients who maybe making great money in their business, but they're not paying themselves enough on the personal side. Okay, that's a client that would work with a B lender. Credit that may not necessarily be at 650, or a client that is overutilized in terms of leverage, where the numbers are so tight, they're at their ceiling with an A lender, we have to go to a B lender. A B lender will work with these scenarios, but they're at a cost. It's not for free. So they charge a higher rate, generally 1% higher than a bank, okay? They also ask you in some areas to put in a higher down payment, like 25% down, unless the property is in a major market. And they also charge what's called a lender fee. They charge a 1% of the mortgage amount on closing in a lender fee, okay? So that's B. And then C is really the private money, okay? Private money is easy to get. There's a lot of supply for private money right now. As an investor, we use private money for many reasons. It could be because of a shortage in down payment. It could be because you need money to renovate. It could be because your deal doesn't fit with an A or a B lender, and we have to go down a private route until we organize things and then take them back to either an A or a B. Private money, most expensive. That's the C money. What do you expect? You can expect interest rates on a first mortgage in the range of 7 to 9, and you can expect interest rates on a second mortgage in the range of, I would say, 10 to 13, okay? Depending on how risky the deal is considered by the private lender. And of course, there are all sorts of fees. There is a broker fee and there is a lender fee. If you're looking for a guesstimate, it's about 3% of the loan amount. Private money is temporary money. You should use it as a stepping stone. You should not use it as a long-term financing capital. So these are the three buckets. Obviously, through portfolio planning, what we try to do is we try to squeeze as much as we can for you as an investor out of group A before we go to B. From time to time, we have to tap into C to give you time to restructure certain things. And again, it's just a temporary stepping stone.
Yeah. So, wow, that's great. So I'm sure that the people that are asking these questions are going to really like the answers because you're going deep into them. I think more so than, they can get just readily on the internet or something like that. We've got another one here from Darcy. And Darcy says, can someone in their 60s still qualify for an investment property? That's a good question.
That is, yeah.
Yes. We have done several deals for clients above 60. And it really boils down to what you qualify for depending on how you're earning your income. It's not about the age, it's about how you're earning your income and where your deal fits. So if you're getting a pension, can we use the pension? If you have properties with some rental income and you have a low pension, how can we maximize on the usage of that rental income to help you, qualify? But yeah, absolutely. It's not really age related.
Okay, so there's nothing really that would be taken into account as far as the age, like the amortization, and they go, man, this guy might not be around that long.
No. It's the amortization is driven really by the economic life of the property. Okay, so if you have a property with an appraisal that comes in and says this property has 20 years left, the lender is not going to give you a 30-year AM mortgage because the asset they're securing the money against is going to live for 20 years. So they're going to cut down the amortization.
Mm-hmm. How often does that happen?
We've seen it on tear down properties. It's common on tear down properties or properties that require a lot of work.
Okay. I haven't run across that myself too. And so I'm just wondering like what's sort of the date? Is it like, is there a date where it's built, or is it more just the condition of the
The
property itself?
condition. So if the appraiser goes in and the property requires a lot of work and, the structure is not as solid, inside and outside is in bad shape, they may put an economic life below, 30 years on that asset, and therefore the lender is not going to lend you a loan that extends beyond the life of the property.
Okay. Darcy, so there's your answer. You don't have to supply a life insurance policy or anything like that when you're applying for a mortgage. Is that safe to say? Okay. You want the next one, Sandy?
Yeah. So we got Sonia here wants to know what is the order that you should utilize the A lenders in order to be able to keep qualifying for financing?
That's a loaded question. Yeah. Really stomp on some banks there. I don't know if that's going to work, but is there a way that you can sort of answer that without and still be politically correct here, I guess?
Well, honestly, there is not a specific order. What we do is we say, okay, how can we get the best out of the first group before we go to the second group? And it's all a numbers game. So I can tell you, oh, here's the order, go knock on CIBC, then Scotia, then TD, then BMO, then go to Home Trust, and then go to Equitable. But it doesn't really mean anything because I don't know what your numbers look like. So it's really driven by your debts and income of where that first deal should go and where the next deal and the third deal can go. Because what you don't see the lending guidelines beneath the service as a client. Okay. So even if you go knock on these doors, you don't even know if you're going to qualify with any of them. Yes, I can tell you which bank is offering the best financing terms today and give you a sequence, but it doesn't mean it's going to work that way. It's really driven by your income and debt. And then once somebody reviews your file, they could say, okay, Sonia, your first deal should go here. Your second deal should go there. We got to make sure you do this so that your third deal goes here. That's really the process. So unfortunately, there isn't really a predetermined sequence that I can list.
I want to stress the importance, people who are listening to this, to having someone on your team that understands how important this stuff is. So it's not just, hey, we can get 6 properties out of CIBC. Like there's a lot of different things that go into deciding on how you should build your portfolio, how you should go forward. And there's so many different variables that, talk to somebody like Dalia, make sure you're doing things right.
And they change a lot too. Things change all the time, right? So someone that's on top of things and keeping up to date.
The rules change all the time. And in regards to the CIBC point you mentioned, Rob, yes, on the surface, CIBC has a great model when it comes to how they look at a portfolio. They use a lot of the rental income once you are beyond your third property, but there is fine print. And the fine print is something called liquid net worth, okay, which not a lot of investors have. On the first 3 properties, you need 100,000. And as you grow your portfolio, you need an extra 10,000. And a lot of investors would say, you know what, I'm not going to keep my money in a bank account sitting idle so I can qualify for a mortgage. A lot of investors are actively deploying their capital into deals. So on the surface, yes, great model. But as an investor, do you have the liquid net worth to be able to qualify with a lender like CIBC, where maybe going to a different lender that is slightly higher in rate, that doesn't require liquid net worth, is where you should go. I'm just saying that these are the variations in lending rules that as an investor, you typically don't see beyond the surface. But as a broker, we know the ins and outs of why things work the way they work and where, if they qualify, where we send the deals.
Do you have different rules as a broker? If somebody comes to you and say they can't qualify with somebody, I know we're just using CIBC right now.
Yes.
As an example, but say they can't qualify with CIBC, is there a chance that they might come to you and you have different parameters that you work with?
Absolutely. This happens all the time. All the time. Clients come to us, Rob, and they say, I was talking to this credit union or I was talking to this bank and they said I maxed out. I need private money. And I say, no, you don't need private money. The fact that you did not qualify with the lender you're speaking with means nothing. All it means is that based on their rules, based on their box, your deal no longer fits there. It doesn't mean that it doesn't fit with anybody else, but it also, there may be some opportunities for us to do things to help you qualify. Example, can we pay down certain debts? Can we, utilize some additional income, maybe from a job, even though that, like a self-employment job, maybe that's a source of income. So can we do anything with debt and income to help your deal qualify? So the fact that it doesn't qualify with one lender doesn't mean anything. Example, we just had a client yesterday, 3 deals, was talking to RBC. He's been an RBC client for 30 years, nothing against RBC, but RBC told him there is no way. Came to us, we qualified him to extract equity, 80%, 30-year AM, advanceable mortgage, excellent rate. He was blown away.
Amazing. I like that.
Don't get discouraged. Don't get discouraged if you're talking to one lender who says you maxed out. It's only their view of the world. It doesn't mean that there isn't anything out there. There is always a solution. There is always a solution.
Well, Dalia, I'll get a little personal here. We do have one more listener question, but I'll get to that in a minute. So the way I work with you, okay? So the way that came about was I had known of you for quite some time, but I got comfortable working with a different broker for, off the bat and whatever. First time I heard of you was at the Investor Forum where you won one of your many awards. And then I think the next year you won the same award again. But a lot of people had told me, talk to Dalia. And the reason that I did was because at a certain point I went to my bank who I had financed with, and they had switched over. So they no longer worked with brokers. Mm-hmm. They had all their own agents who now you had to go to an agent at the bank and try to work things out with them. Well, I said, I want to refinance 2 of my properties. And they said, nope, that's not going to happen. And I said, listen, I'm going to leave if you don't help me out with this. And they said, yeah, well, bye, because we can't. There's nothing we can do. My hands are completely tied. I would love to help you, but I just can't do it. And that's how you and I hooked up. And it's interesting how much I've learned just from working with you on the things that we've talked about today. Just, not necessarily the most important thing is the interest rates and that kind of thing. So
thank you, Robert. It's been a pleasure working with you as well. We learned a lot from you as well.
Oh, well, thank you. Last question from a listener here. Tara wants to know if there are certain things you can stay on top of to make a smoother qualification process.
Absolutely. So we're big believers in planning financing, okay? As much as you can come to a broker with a deal and say, I got an accepted offer, figure it out, okay? And they can plug this deal into, work with a lender to get you approved. That's really not the best way to do it. Planning is key. So what we have is something called an approval binder, okay? The approval binder is something we share with every investor that is planning to invest in real estate, whether they are starting out or whether they're gonna grow their portfolio. That approval binder states everything you need to prepare for as an investor from a financing standpoint and send it to your broker. This way, you've got all of your ducks in a row, you've thought about everything, your broker is organized and has pre-qualified you hopefully for your next set of deals. That is very, very important to do. We do it with every client. And some clients complain about the paperwork, okay? And they will complain about everybody complains about the paperwork right now. Unfortunately, guys, okay, need it. You're going to deal with it sooner or later. So it's better to deal with everything up front so you have a smooth ride. No surprises. Don't figure out down payment in the midst of a deal. Don't figure out, where the money is going to come from in the midst of a deal. Don't figure out that you haven't gotten your tax return in the midst of a deal. Everything has to be dealt with up front. And then again, it's a cookie cutter. So that approval binder, in my view, is key for every investor.
So that would be something that you could contact them. They could contact you for, and you could supply them right away.
Absolutely. If they email us at info@streetwisemortgages.com and request it, we'd be happy to share a copy.
Okay. Thank you. I'm going to go back because I don't think I got quite the answer I was looking for on the student rental refi. And so we had talked about how, like, let's just say the property value has increased over 5 years now, and you want to go back and pull some of that equity out. Would they be able to do that with it being currently used as a student rental?
The answer is yes. Okay. The question is, where would it go? Because there is a group of lenders that love student rentals and would give you 80%, 30-year AM, great rate. And that's where I want to put the deal. Okay. So this is what I was referring to earlier. Best to have a master lease agreement, not a room agreement. But also it's important to know if you're going to grow your portfolio beyond this, beyond 5 rentals, want to make sure that we line up a lot of equity from your student rentals before you cross that bridge. Because once you cross the bridge into the 6th or 7th rental, you wouldn't be able to easily work with some of these lenders who offer great terms on student rentals. So that's what I was alluding to. It's a refinance, best to have a master lease agreement, but before you cross the bridge to the 6th or 7th rental, want to make sure we line up a lot of equity in your student rental so that you don't hit what we call a financing wall with these group of lenders that do student rentals.
Okay. And conversely, if someone was to, let's say the end of the term comes, their students leave, now it's not a student rental. It's just a single family home.
It's a regular rental refinance. The universe of lenders available for student rentals is a smaller universe compared to the universe of rental lenders that would rent on just a regular rental. So can we get great terms on student rentals? Absolutely. Can we refinance them? Absolutely. We just need to be, proactive about how we go about the process, because the group that finances them has guidelines around the number of properties a client owns. So you don't want to really cross that bridge into the 6 or 7 rental until you have lined up equity from your student rentals. But if the students left and it's a regular house, yeah, no problem. We can finance it anywhere.
Okay. No, there's a lot of mystery around this kind of stuff, around the student rental, financing and refinancing and all that stuff, especially. So thank you for clearing some of it up.
You're welcome.
That was a lot of info. That was some good info.
There's a lot of stuff to cover.
Yeah, we've talked about a lot of. We've talked about finance, many different times, and with mortgage people, with non-mortgage people, and people just like in the business of real estate. But there's a lot of good stuff there. The advanceable mortgages. I don't know if we've ever talked about that.
We haven't. So
that's a great tip.
Yeah. And up until recently, I think someone led me to believe that wasn't possible on income properties. So
do it all the time.
Right on.
Just need to know the right people.
Yeah. And I think that if anyone has any questions, I'm sure Dalia would certainly love to spend hours and hours answering them all for you. So. Or maybe a quick email might be better.
Well, how can people get in touch with you, Dalia, if they want to reach out and learn some more about this and hopefully do some business with you?
Well, we're very reachable, myself and my team included, and clients can reach us in different ways. They can email us at info@streetwisemortgages.com, or they can go to our website, streetwisemortgages.com, and fill in the contact form. or they can go to our website and they'll see all of our team phone numbers. They can call us directly, or, you know, call our 1-800 number, which is also on our website. Either way, we'll be happy to help and we'll get in touch with you.
So maybe, thank you, Dalia. So maybe as far as our contacts go on the website, we'll just put your link to your website.
True. Yeah.
Let me start that again. I was
Easy.
just going to say, maybe what we'll do is we'll just put your website on our contact space on our website. And that way, that's probably the easiest way for people to get in touch with you.
It
Sounds
is.
like they can get all the different points of access from there.
Yes.
Great. Well, again,
keep it simple.
Yeah. Thank you so much for sharing all of this.
You're welcome. My pleasure. And I know there is a lot more to cover, but I tried to, you know, focus on the key points. But happy to answer any further questions.
You know what? We could probably have like a specialty podcast regarding certain different points that, you know, someone might encounter struggles with as far as financing goes. Maybe we can do like a specialty episode with you sometime.
Yeah, sure. That's a great idea, because if you're hearing certain things from your clients about financing and you want me to dive into these topics, we can do that.
Mm-hmm. Great. Well, thanks again. Thanks for having patience with us and actually coming back time and again to try and get this done.
Yeah, no problem. I appreciate the opportunity, guys. Technical things happen all the time.
Yeah, thanks, Dalia.
Always.
No, lots of value here. That was awesome. Appreciate it.
Okay.
Sandy, how can people get in touch with you?
Yeah, 289-389-6846 or info@mckayrealtynetwork.com.
And if anyone would like to get in touch with me, I'm still doing those property tours, specializing in secondary suites and student rentals in Peterborough and Oshawa. So we've got that those markets locked down. So if anyone is interested in learning more about them, coming out on one of the educational tours, get in touch with me, info@breakthroughreipodcast.ca. Any other questions, any guest recommendations, anything you want to know, any comments you want to make, info@breakthroughreipodcast.ca. Thanks everyone for listening. Have a great night.
Thank you very much.